Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The USDA report is scheduled for this Friday, and the downtrend that we have seen in the corn market continues to trend along our demarcation line and is consistent with the move that we've been expecting on the way down. We do suggest exercising caution in terms of trying to forecast or predict where the low will come in terms of price and or time. Our suggestion would be to simply wait for the market to give us confirmations that a low has in fact come in, wait for some basing, and allow the market to start to trend up so that we can move with the trend itself instead of trying to catch it at the exact low, which is very difficult or challenging to do. From this perspective, we can see the market has come into volatility-based support, and it is riding right inside of the 354 to 360 region. Upon breaking 354, we could see a little bit of a move to the downside, perhaps at 350 mark that we just discussed. But as long as the market's able to hold inside this region over the next week or two, this would be a very good area to find a good positioning for the market to look to be able to trend up from here. Upon breaking back above 361, then something can tell us that the market's looking for the leg up. And from there, we could trace the market from that move. The July and December contracts are going to communicate something very similar. As you can see in this move here, the market also continues to trend along the speed of this trend line. It is very consistent with the downdraft that we've seen. At some particular point, the market will be able to find or base itself and then turn back up again. Likewise, this July contract is sitting right inside of volatility-based support. We have our next area of support falling down to about 356. There's a very good chance that the final low could come in somewhere near 360, and then from there we can see the market trend back up again. Again, going into the report on Friday, we expect to see a bit of volatility and some extreme movement. So again, we do suggest exercising caution as we approach this upcoming report. The third of the corn contracts is this December one. And once again, we can see a nice move to the downside along our natural green trend line here, mapping out for us the speed of the market decline. In addition to mapping out the speed of the decline, the markets come into reasonable support near this 380 mark. This is where the market's bounced a bit. Again, you can see the market actually did make a move to the upside today, but has given most of that movement back up again. And you can see as well as we have a time factor coming in consistent with the report announcements on Friday. Upon hitting volatility-based support, the market is moving as would be expected. As we've shared on numerous occasions in the past, once the market comes in and touches volatility-based support or resistance, expect the trend to either pause or reverse. Now here we can see for the last 5 to 7 trading days or so, the market did come in and has simply been sideways after having hit that key support level. Moving on to soybean, we can see here that the decline has been very consistent with what we've projected over the past few weeks. When the market was first setting up, we showed you how the consecutive 3 lower highs suggested that the market could very well give us a move that would give us a very big or fast move to the downside. That's exactly what we got after the market came out of these consecutive 3 lower highs and lower lows. Upon giving us that break, the market has since given us a bit of a consolidation. And what we are also noticing right now is that the market has given us a 5-wave sequence on the way down. By way of that 5-wave sequence, we're looking at wave 1 coming in here, wave 2 coming in here, wave 3 completing here, then giving us a sideways wave 4 consolidation possibly, and then completing potentially somewhere near this area of 969, 970. Now, we do have the possibility of the market continuing a little bit lower with a big move to the downside upon the release of the report on Friday. But it looks like soybean may finally be pausing and the decline may finally start to slow down a bit. What you'll notice here is that the market is actually very close to volatility-based support. It is not quite there as of yet, so the possibility of making a final run in the neighborhood of 950 to 955 is still possible. The last time it hit its volatility-based support band, you can see once again it consolidated for at least 5 to 7 bars or so. And then once that consolidation was done, the trend then continued to the downside, and we're making our way now to our next band. Once the market hits this band, we can look to see another potential consolidation once it hits this move, or in fact, a potential change in trend. So it'll be very interesting to see the way in which this market responds in the event it comes down to the neighborhood of 955. Moving on to the July contract, we once again see very similar formations to what we saw before. A nice consolidation. We're in the midst of a small one right now with the potential for the market to come in perhaps somewhere in the neighborhood of 970. That 970 area is confirmed when we look at our volatility-based support band. That range comes in somewhere in the neighborhood of 960 again to about 971. So the consolidation that we're seeing now is right at our 360-degree mark. And upon breaking here, the market may finally come to a pause. The November contract suggests the potential for a time factor coming in where the market may in fact turn up from here. We're also sitting right at the intersection point of two 1-by-1 angles. If the market's able to make its way back above this support/resistance level right inside the market here, we can then see the potential for the market to make its way back up again. But this 972 to 973 area is going to be very important for this contract in terms of looking for some confirmation of a reversal of trend. Next two key levels of opportunity in the event that the market does break down would be at 964.5 or 964 3/4. And upon breaking there, potentially even getting down to about 950. These are two areas we'd be looking at. The market does look like somewhere inside of these two regions is going to be a very good spot for this market to pause. Something similar or akin to the length at which it broke out of this previous consolidation would be something consistent on the other side, perhaps landing us right at about the 960 mark for this contract. Wheat futures continue to look weak. They made a major high back in February, and now we have the potential for an Elliott wave 5-leg sequence on the way to the downside, where wave 1 would land at the first major low that was made in late February, followed by wave 2 coming in with a subsequent lower high. Wave 3 perhaps is where we're sitting right now, and because of the length of this movement here, we could be looking at a movement that gives us a consolidation for wave 4, followed by one final leg to the downside. And it's at this point we could see the market finally put in a significant low before this particular contract could consolidate some. But we continue to see continued weakness for wheat and not showing very much sign of a big bounce or a big recovery. But in essence, a sideways movement perhaps is the best that it will probably be able to do. Upon breaking down below the recent sideways consolidation, a downside target perhaps is somewhere in the neighborhood of about 420 for this market to find a significant low. Most recently, we have been consolidating in the area of the volatility-based support band, but again, upon breaking here, we do like that 420 number, which happens to be consistent with the previous major low that the market made early in the year. Crude oil futures are in that consolidative state that we spoke about before, although the recent move that we're seeing now suggests that a potential significant low was made here, and we're getting a nice pullback as we discussed before, with the opportunity for being able to get back in for one more leg to the downside. We have key resistance coming in, perhaps in the neighborhood of about 52. So in the event that this market can continue to make its way up, come into resistance and roll back down, that would be a nice potential for another short opportunity and giving us a potential leg, something akin to what we had seen before for the market to come in and perhaps make a final low somewhere in the neighborhood of 46.25 with the potential of coming in as low as 44.64. Special note today, the UK has triggered Article 50 and has officially put its notice to exit from the European Union. In doing so, we have noticed that as the markets have been moving towards this particular date of the triggering of Article 50, that the US dollar has been inside of a decline. Mind you, several weeks ago, we had shared how the market was in the midst of a pullback, but where that initial pullback occurred, we suggested that these were not good spots to short, but instead to wait for the market to hit either the 62% retracement level or the 78.6 level. The market did finally hit that 62% retracement level, and as can be seen in this chart, our minimum price objective of about 99.42 has been hit as of a couple days ago, and the market made a very nice decline on the way down for that particular trade. Today, the dollar is moving up over the last couple of days, bouncing off of that target threshold. It remains to be seen where the market would move from here, but wanted to highlight for you some of the key levels that we can see as we understand where key support levels live. At the time of this movement, the market was actually making its way up to being overbought, and that is part of what enabled us to believe that the market was due for a potential decline. These Fibonacci levels give us an indication as to where the market may pause and may make reversals. Thank you again for joining us for our weekly market update, and look so much forward to touching base with you again next week.